Welcome to the Business of Soil Health. I'm Patrick Smith, the founder of Soil Upside.
And I'm Sammy Telleton, the co-founder of FarmRaise.
I am really pleased to have Sara Balawajder, the Director of Investments at Builders Vision, with us here today. Welcome, Sara.
Thank you. Excited to be here.
Yeah, wonderful to have you. So Builders talks about funding scalable climate solutions that also drive financial returns. We'll talk a lot about that throughout the episode, but can you start by giving us a little bit of a context around Builders itself?
Yes, happy to lay the ground there. So Builders Vision is Lucas Walton's family office. And as a family office, we are focused on allocating different types of capital to climate change solutions in three distinct themes. Sustainable food and agriculture is one, renewable energy is another, and then our third is healthy oceans. And there are three groups within our platform that are allocating that different types of capital. On one side of the house, we have Builders Initiative, which is our philanthropic arm that's allocating grant capital to those issue areas. On the other side of the house is Builders Asset Management, which is a traditional asset management firm that's managing a couple different pools of capital, investing in funds across asset classes. Everything is market rate, and they're trying to invest for impact where they can in those issue areas. Scale is often a challenge because they write some large checks in some of the portfolios. And so there's always a do no harm component of what they're doing, but everything is market rate and trying to align to our Lucas's values. And then there's a third group, which is the team that I lead called Builders Bridge, which sits in between those two teams. And it's an early innovation portfolio where we have a dedicated portfolio to those three climate sleeves. I've historically managed our food and ag portfolio, but our objective is really trying to identify the market white spaces in between philanthropy and traditional asset management, where we can come in early, de-risk the opportunity, either by writing direct equity checks, financing through debt, or anchoring funds, so that we can make the opportunity attractive to institutional capital down the line. And so it may look concessionary from a risk return perspective when we initially invest, but our ultimate goal is to fund and invest in things that we think unlock systems change that draw institutional investors in to participate down the line.
Okay, so just to kind of repeat back to make sure that I understand. Builders Vision is the umbrella, and you have three different groups within Builders Vision. You have Builders Initiative, which is philanthropic. You have Builders Asset Management, which is later stage across asset classes. And then you have Builders Bridge, which is where you're involved, and that's early stage investments across all different types. It can be fund to funds, it can be direct investments in companies, equity investments, it can be debt, it can be all sorts of different instruments. Is that a good summary?
Yes, that's a great summary.
Okay, great. Then we're going to focus our conversation today on Builders Bridge. I'm curious about, you mentioned that it may look concessionary in the early investments. Can you talk about kind of the returns that you're underwriting?
Yeah. So it really depends on the financial tool that we're utilizing. So when we're talking about debt, I would say like currently we're underwriting debt at probably 8 to 10%. And most of the time those counterparties are not bank credit worthy. And so they might be getting quoted at 20% if they're going to their bank or even farm credit, like trying to get debt. And so we are coming in well below market. On the equity side, sometimes it's venture, sometimes it's project finance. It really just depends. I would say from a venture perspective, we are not shooting for the moon with our investments. I don't think the power law exists in these asset classes. And so we're really looking for steady 3 to 5x returns on average across the portfolio, and really not looking like, I think we're trying to be realistic that 100x return is probably not going to happen. I hope that I might be wrong on that, but I think we're going in eyes wide open. And then funds, I really do think we are market rate in that. We can talk about the types of funds that we've invested in, but it's really comparing their benchmark as to their asset class. And sometimes they may have a first loss tranche or a concessionary tranche, and we have chosen to participate in that because we hope it makes it attractive to other LPs to come in later. But ultimately, we hope that they get to one share class down the line, and they don't need kind of this de-risking mechanism to make it attractive for other LPs to come into.
Thank you, Sarah. As a founder myself who raised venture funding with my team at FarmRaise, it's cool to hear how you think about equity returns, especially at the early stage with that 3 to 5x return on average across the portfolio. How do you think about defining yourselves as early stage equity investors and companies? Do you describe yourselves more as impact investors? Do you think of yourselves as venture investors? And how do you think about the relationship between impact and returns there?
It's a great series of questions, Sammy. And there's a lot that I feel like you're living in my brain right now as we think about how do we describe ourselves, because the way we show up is so unique because we have these different tools. When we're talking about impact investing, we want to make sure that we are clear that we have line of sight to market rate, and like we want this to be attractive to market rate investors down the line, and you don't have financial return and impact don't have to live separately. I wouldn't call ourselves a venture shop. I think when we're talking about early stage, it's really identifying where's the forefront of these industries going and where are the gaps that need funding early to help them develop. I think when you look across the entire Builders Bridge portfolio, and particularly in our food and ag sleeve, we are almost rarely showing up in venture. We think venture is one important tool in the toolkit, but we're actually seeing the most capital gap in all of the other funding sources needed to support the industry. And so as we are trying to morph and fit these capital gaps, it's actually everything but venture is where it's showing up. And so I definitely wouldn't call ourselves a venture capital firm. So yeah, was there another part of your question? Sorry.
Yes, I bundled a lot in there. So I think the last part I'm curious about is matching your return and impact goals and how you think about that 3 to 5x goal. Does that align with the impact goals that you want to achieve? Do those two goals inform each other as you think about your strategy and your portfolio construction?
Yeah. They're deeply, deeply intertwined. So the way we have gone about deploying from Builders Bridge is a very thesis-driven investment approach, where in food and ag, we had an allocation from Lucas, and we started saying, okay, where are we seeing the most need? Where do we think that we need to help facilitate the transition to better sustainability practices on farm? And what are the sectors that we think are going to do that to unlock that systems change? And from there, we went out and started to look for deal flow in that area and start doing landscape analysis for it. And so the impact really drove the strategy. And then we started to identify the deals that we thought would deliver on the impact and then start to underwrite the financial return of the deal. I think I have increasingly come to appreciate that unlike venture, and where I think that this is not power law, and I think this is going to be more of a 3 to 5x return, like we're seeing that in the types of exits that are happening in the industry in venture. Things are just slower. And so I'm also thinking about how do we measure our success? And I think it's more of a multiples game than an IRR game, because I do think this is going to take a lot longer than 10 years, particularly in ag. There's one growing cycle a year. Product market fit is harder to establish within those confines. And so I think we're accepting that things are going to have to take longer. And so like, let's meet the opportunity. Like, I think it's silly to force a financial tool on the opportunity that's not the right tool for the sector. And so by definition, your IRRs are going to be blown out and then I guess contracted, not blown out. And so we need to be thinking about our success in terms of multiples, and 3 to 5x on average makes more sense. And if we're talking about venture deals, than assuming that one deal is going to return 100x, because I can't even name one deal that has done that in the last 5 years in venture, where we've seen some nice exits in the 3 to 5 space.
You know, it's interesting because if you're talking 3 to 5x, you're not power law and you're longer term than most closed-end venture funds. You know, those are obviously you're changing up most of the major kind of financial levers.
Yeah.
But there's one that I'm very curious about, which is portfolio survival rate. How do you think about portfolio survivability?
Great question. And when you describe it that way, it sounds really difficult. But I think you have to be choosier. And our approach is not the spray and pray model. Like, we are going to be super intentional with those that we write direct equity checks to. We really don't write many of them. And when we do, it's because we think that we can lean in. We think there's a very specific role that that company plays in the systems change and the product market fit. And so it plays into exactly what you described, Patrick, is like, we can lean in, we can force I don't want to force for survivability, but we can help facilitate, and we have high conviction in survivability rather than taking a bunch of small bets. But I think you would see in our portfolio construction, like I said, we are not writing that many direct equity checks, and we diversify downside loss with our investment in funds, which are getting greater diversification in. And then we're actually seeing a greater and greater need for debt in the space and operating capital to provide a replacement of venture debt, but on more favorable terms than an SPV or project finance operating loans, those types of things, where there's just a total dearth of capital. And these are great cyclical businesses that just no one is there to provide them the operating capital and debt financing that they need.
That to me sounds like you're dealing with infrastructure businesses or businesses that have high OpEx, so high inventory carrying costs.
It's really not that much SaaS.
Right. I was going to say it's not software. You're talking about like hard
There's
goods.
great venture firms who are doing that. That's just not the role that we see in being catalytic.
Right. Yep.
I'm having this really fun full circle moment listening to you, Sarah, because this season we've been exploring through our various speakers how we need to think about the financial side of regenerative agriculture differently than how we think about conventional agriculture. And you saying, we have to solve for multiples rather than IRRs because things take longer. The way that you're talking about the need for this debt funding to come in for the operating capital reminds me of this, which is really building these perennial longer timeline systems. And I wanted to know if there's a conscious decision within your team to embody some of those principles of perennial systems or regeneration and how you construct and think about your fund and portfolio.
Yeah, we're going through a strategy refresh right now. And I think where we're leaning towards as an office, as we think about our food and ag strategy, is how do we support a diversified cropping system that leads to planetary health and human health? And a lot of that is in perennials. And so that is it's like you're in my brain again. I mean, like that's what our ethos is. And we're asking ourselves the question, like, how are we going to do that? That's really hard. There's a lot of entrenched systems that have made it the annual crop, commodity crop business that it is today. And how do we start to pull different levers to change that? I think it's crop R&D on seeds. It's building new marketplace for different crop types. And like, what is the offtake in it? I think when we think about offtake, it's food, fiber, and fuel. Within fuel, how are we thinking about sustainable aviation fuel and different feedstocks that aren't ethanol or soy? And feed, it's how are we thinking about the different offtake that aren't corn and soy, and like what is price competitive for feed? And then on the human consumption side, it's how do we change our diets? And we're not super interested in going after individual consumer behavior shifts because that is very hard to do. But how do we work with institutional procurement to integrate more plant-based protein into the diet when you have a captive audience in a hospital or a university system? And how do you get them to serve more lentils, more beans, and things like that actually reduce the animal-based protein? And so you're reducing the animal feed need. And so you're kind of tackling it at two different ends. And so those are a lot of the questions we're asking ourselves right now. And like, how do you start to deploy capital in an investment way that starts to build those marketplaces and pulling on the different levers to make that happen? But we're in very early days, that 2.0 version.
I want to circle back to what you had said a minute ago, where you were talking about you're not so much on the equity side. You're talking about other funding sources where there's capital gaps. You mentioned debt. But I'm also curious about some of the other emerging structures. So recoverable grants, revenue share, profit sharing, capped returns, like all of these different kind of emerging, more equitable, not non-extractive, less extractive from
Yeah.
founders. How do you think about all those alternative structures?
We are always exploring different structures. We are huge beneficiaries of having an amazing in-house legal team that think really creatively in how we structure deals, pulling in the expertise of some outside firms to think like beyond just the standard convertible note or safe or even just typical equity check. And so there are a couple things that we've been spending time on to think about how do we work towards just being creative in structuring our deals. One idea that we're currently batting around on right now is redeemable equity. And we really like this idea in theory. We haven't actually used it yet. If you can pre-negotiate with your founder, what does their takeout look like? I think sometimes we wonder, what is the right exit for the business? We want the founder to have skin in the game. We want the impact to remain intact. And if we can exit back to the founder in X number of years and we've like pre-negotiated some of those terms, like that's a huge success. And we've participated, given them the operating capital they need, and then let them have the business back or they buy it back from us at an agreed upon term at the end of that period. That's something we're really excited about. I think there is some nuances and some things we have to work on to make that more attractive to other investors who want to come in. If we have like this deal like that there's some things there that aren't quite perfect, but we're very open to different structures. The other idea that we've been thinking a lot about is like a holdco light model for some of these businesses, particularly as it relates to like asset heavy operating businesses or processing facilities, where we don't necessarily want majority control, but we want to be hands-on with the entrepreneur or the business operator to help them drive efficiencies in their businesses. And then the one thing that we kept hearing as we talked to a bunch of different entrepreneurs who had successfully exited their businesses, and this largely plays into like the CPG space, is you built this amazing brand that is high integrity, high impact, and then you sell it to a large CPG. And then what happens? And you lose a lot of all of this, the special sauce that went into founding that business. And that just became a really depressing reality to us as we started to talk to these entrepreneurs and kept hearing about these test cases. And so what are the alternatives to exiting to a large CPG? Could you build a private equity structure where you have aligned shareholders that these businesses just exist in perpetuity and spit off great dividends on a quarterly basis and everyone kind of wins? And I don't quite know what the exit ultimately looks like. Like eventually people are going to want their principal back, but they can make it up through these dividend models. These are some of the questions that we're toying with as we're underwriting and trying to get creative about the right financial tool for the opportunities in the space.
Are there folks that you're looking to or learning from on the redeemable equity side who are implementing that model in a successful way?
It's a good question. There's one family office that we saw, I don't want to name names, that we saw use it and it was successful. We haven't seen it that often yet. I don't know if you all have seen it, but like we're very intrigued by this opportunity because if you have like a pre-baked exit into it or there's milestones, like it doesn't have to be like this is your price on this date. It's like a threshold amount. If you hit these milestones, these are the types of exits that we can contemplate. So no, I don't have specific examples for you, but we have seen it used occasionally.
I'm really encouraged to hear you talking about, the alternatives that you're exploring. And as a founder in this space, it's also very frustrating because we don't have the equivalent of safe notes. We don't have there's not one standard structure that people turn to. It's like, oh, it could be any number of things. And which investors are doing what? It's super hard to figure out. So I'm curious how you think about that, extrapolating your experience to the space as a whole.
No, it's a good call out. I think we struggle sometimes where we can be super bespoke and be super creative in our underwriting, but we need to keep line of sight that it has to be attractive to other investors. And I'm constantly harping on it needs to be more vanilla. It needs to be more vanilla. Because the fact of the matter is, like, if an investor doesn't understand it, they're not going to invest in it. And if you overcomplicate it, you're just like, you're shooting yourself in the foot. And so you really need to toe the line between creating the structure that's appropriate for the opportunity, but not overcomplicating it so you scare people away. And that's a really fine balance that we have to walk, because we could come up with this really cool term sheet. We're like, what is that? Like, it doesn't really matter because no one else is going to follow us into the deal.
Yeah, you're talking specifically about downstream investors in that same company.
Or in that same round.
Yeah,
too.
right.
On the flip side, I could see though, like the powerful role your work could play in the sector writ large by pioneering different models and sharing what worked, what didn't, and kind of leading the way forward on innovation in funding mechanisms themselves. So I hope you do keep exploring different models, because I think it's leadership. It's really important to get out there and learn from that on the ground.
Thank you. I have to give a ton of credit to our legal team. They are really the brilliant minds who come up with the structuring, and we're kind of like, yes, no on the business terms. So I like that. Like, maybe we'll write like a playbook one day on like what works, what doesn't, what resonates,
Yeah.
what doesn't with folks.
I would read that.
Thanks. We have one reader.
Speaking of sort of supporting the ecosystem, can you talk about your role in bringing other investors into the space?
Yes. So a huge mandate directly from Lucas is to catalyze other capital into the space. While we have a pretty significant amount of capital to deploy, it's not enough to fill the trillions of dollars that are needed to drive the system change and these climate themes. And so I spend a significant amount of my time networking with other family offices, other investors, sharing what we know about the space and sharing opportunities. And so how that tangibly shows up is we will share our diligence with people within our network. We make them sign a non-reliance letter, but we will actually send them our investment memo with the permission of the investee partner, the fund manager, or the entrepreneur. We find that often will help speed up the diligence process if we've already done a lot of the heavy lift there. I do a lot of reference calls for our fund managers or our entrepreneurs. And when we're investing in a fund, we try to be in the first close, because we find that if you have a cornerstone investor in the first close, it helps to alleviate some of the stress of like the first mover. What else do we do? We find that there's a lot of curious family offices who want to deploy into this space, but don't really know where to start. And they don't want to hire a big team like we have at Builders Vision. And so they'll come to us for advice of like, okay, how did you think about this? How did you come up with your thesis? And we're an open book. We are very collaborative. The more, the merrier in the space. And we just need more funders into the space. And so we try to be as helpful as we can. And I feel like we want to share, and we want great partners to come into these deals with us.
You know, one of the things I've noticed in talking to other family offices and impact funds is that there's a lot of duplicative work. So many landscape analyses. Oh my goodness. So I'm curious, how do you think about like open sourcing some of the foundational work that you've done in the space?
That is a great question. We will share our landscape with family offices as they are like, hey, we're interested in looking into farmer financing. What have you looked in this space? And we'll pull up our landscape and say, here's our list. And then here are the ones that we chose. But I think making that open source is great. There are some investor networks that do that. Like the Creo network has a database that has some of that landscape on a thematic level. But I think that's a great idea. I had a joke with Sarah Nolette at some point that like landscaping is either like you're actually landscaping because you want to learn to invest, or that's like the euphemism for like, thanks, but no thanks. We're like in the middle, like we'll come back to you when we're done landscaping. So most of the time when we're landscaping, it's because we're actually trying to learn something and make a decision if we're going to move forward.
Nice. I'm so curious to hear about a deal that you sourced or led for Builders, if you can share.
I might point to my first deal, that one of the first deals that we did in our food and ag portfolio that's doing really well. I'm just really proud of the team and where they are today, and that's Mad Capital. So when we first started investing and got the allocation for our food and ag sleeve, that was 2022. So not that long ago. And I was just trying to get a lay of the land. And we identified the system frictions that we thought were preventing farmers from adopting best sustainability practices on farm. And access to capital was like the number one that came up. And so that's where we started. And so we did a landscape analysis and Mad Capital rose to the top, as did Fractal Ag. And we invested in both of them at the same time because we liked the debt and equity component in comparison. And they've both done outstanding. They're both filling a really important niche, space and niche within the ecosystem. And Mad Capital has just been crushing it on the fundraising side. They're raising the hard cap and they're going to have a final close in September. And it looks like they're going to get close to their goal of $70 million, which is just a major win for the Regen Ag organic ecosystem. And it's just been really cool to see what Brandon and Phil have built and the reputation and the ecosystem that they've created in the space that I know you all are all part of. But that's just a team that we're really proud of all of our partners. But it's just really cool to see one of our first ones have that success in fundraising. And it's been a slog. Like, it's been a lot of hard work, but they're getting there.
I'm glad that you brought up those two examples because, the thing that's going to drive transformation in the space is being able to get capital to producers so that they can actually transition the acreage that they steward. And so I'm curious how you think about that in the sort of vein of impact. Is that part of your impact hypotheses? Is that something that you look at explicitly deal by deal? Like, where does that fit in your world?
Getting capital to producers.
Yeah. Mm-hmm.
Yeah, that is one pillar of the system frictions that we think about. It's interesting that you bring it up because I think we think about it most explicitly in access to operating capital as you're transitioning land, or in capital like Fractal provides in acquiring new land to transition. But we think about it we started to think about it in a broader context too. Like, venture capital is technically providing access to capital to entrepreneurs to provide solutions to farmers. And so we think about that more broadly. And so we also invested in Tenacious, where we're an LP, and that's our only stake in a venture fund in the Regen Ag space. So I think about that in terms of access to capital. And then I also think about it in terms of downside protection and access to capital for farmers. And insurance is tangentially, I think, part of that. And so that's an area that I am actively looking for opportunities in, as far as downside protection and making sure that farmers are made whole through that transition, or should there be peril events that happen.
Yeah, risk products. So we've identified 12 financial levers for soil health. One of them is risk products. And, people think immediately of crop insurance, but that market is completely distorted given all the public policy. I'm curious how you think about risk products. You said you're looking for an opportunity in that space right now. I'm guessing you've done a landscape analysis. How do you think about risk products and the opportunities there?
Yeah, I think it's a really difficult space. I think that's why we haven't seen a clear winner emerge yet. And it becomes ever more complicated under this new administration of will they or won't they change the federal policy. I think our ultimate goal is to fund not a short-term solution, but a gap filler in the private insurance market that's actually affordable for farmers, because whole farm insurance is not affordable. And if we're going to ask our farmers to take on this level of risk, like, they need to have downside protection. That's asking a lot of them. But I think my ultimate goal is that the federal crop insurance policy changes. And so what is that gap fill in insurance that we can provide? And I think there's a total misperception of risk on it. And so I think those who want to invest in the space aren't actually going to expose themselves to that much risk. And then how do we think about getting the necessary data solutions to feed into the actuarial data that changes federal crop insurance policies? And so I think there's just kind of like the sequencing that we need to see happen over time.
You're talking specifically about on-farm risk mitigation,
but
there's also risk mitigation throughout the value chain.
Yeah.
Middle of the value chain, the buyers, the commodity buyers like CPG brands, and there's risk products for those participants as well. Have you started looking at anything in the value chain?
We
risk?
haven't done as much for those participants as well, but I think an interesting lever that we can start to pull on, because we also have a very large public equity portfolio, and how do you use that for activism and engagement? That's not my portfolio, but colleagues who manage that, is how do you work with those large corporates, public corporates, to help them acknowledge that they need to care about this, not from like a branding perspective, but from a risk perspective. And while it's not a specific financial product, how do we start engaging with the chief risk officer instead of like the chief sustainability officer to talk about the risks of their value chain? Like we're seeing it in cocoa and coffee. It's only a matter of time before we see it with commodities here in the US.
As we think about your metrics for success, we've talked a lot about returns and we've even explored some of the different solutions that you're excited about, that you have funded. I'm curious now to talk a bit about impact. So how do you all measure the impact of the investments that you're making?
I'm glad you asked, because we also have a great in-house impact measurement and management team that we bring in during our diligence process to identify the key metrics that we want to report on throughout the life of an investment. We have made the decision not to roll up all to carbon or GHG or methane as an organization. But as an organization, we've set North Star goals, as I described earlier, of like, what are the system changes we want to see? And then we're going to identify a suite of indicators that we find that are important and actually attach metrics to them. And so it's not one, but a series of them that we're going to pay attention to. And we can pick and choose the ones that are pertinent to the investment at hand. What we really want to avoid is just collecting impact metrics for the sake of collecting impact metrics. Like that doesn't serve anyone. And so what actually matters, and how is it going to demonstrate that we're achieving our goals? And so it really varies investment by investment. So on Mad Capital, it could be acres that have been converted. It can be carbon. It's GHG emissions. So it's all of those things. It's not just one. And we send out a survey on an annual basis that we ask our partners to fill out. And it goes from our grant partners to our fund managers to our partners in our Builders Bridge portfolio. And then we aggregate that information. And we have put out an inaugural impact report. I think it was last year or the year before. It was a lot of work. So I don't know if we're going to do it on an annual basis, but I think maybe every other year we're going to report out, and we always report internally, but every other year share out externally to share how our portfolio across the entire Builders Vision platform is performing. But it's really important, and my success is measured both on financial and impact success. And we also have financial incentives in-house that are tied to both, which is unique.
That's huge. Yeah, put your money where your mouth is, I guess.
Yes,
in that.
exactly. But I appreciate it because it's really hard to do both. And if you're only reporting on the financial side of it, you're missing half the story.
Absolutely. What made the impact report so time consuming to produce?
It was a beast. We probably had like 500 to 1,000 line items across the entire portfolio.
Wow.
And so figuring out like where things could roll up in certain metrics, getting some of the qualitative stories to come out. We hired a group to help us actually publish the report. It's really beautiful. I'm going to send it to you. But it was a very large undertaking. And so like what do we need annually for like us to demonstrate we are on track? And then what do we need to put together and at what cadence externally to help share and hopefully encourage other people to try to do similar.
How do you think about impact in portfolio construction? So in a fund, there's typical portfolio strategies around return, and it's relatively easy to aggregate return and think about how do you construct a portfolio to do that. How do you think about aggregate impact across the portfolio? And are you trying to intentionally construct the portfolio to achieve those goals?
As part of this North Star office design, there are specific indicators within our food and ag cross office holdings that we care about as far as indicators. We work with our IMM team to identify those. And then we
Sorry,
take those
IMM is
impact measurement and management.
perfect.
Sorry. And then we take those indicators and as we're looking at new investment opportunities, we are tagging the ones we think are applicable to the investment. And so any investment that we make in food and ag needs to somehow tie to those North Star goals. And so inherently we're rolling up to those long-term vision, and there may be dispersion over what the indicators are, but there should be overlap. So like acres converted is a big one for us. Organic matter in soil is another one. What else do we have? We're in the process of redoing them because we just redid our North Stars for plant diversification and diversified diets. But we are thinking about them as like, how do we think about it holistically from portfolio construction?
Cool. I'm sure that, there will be entrepreneurs listening to this, given your position and given people's, need to raise capital. You mentioned your diligence process. So what would you say to any entrepreneur that's listening? What do you look for? What are your criteria? How do you think about the team? How do you think about the opportunity? It's obviously different than venture. So what are the rubrics that you use?
No, it's a great question. So I think we are most regularly, like our initial thing is looking for product market fit. Does the opportunity fit with one of the things that we've identified within our thesis? And so it's a fit for a thesis. And then is the entrepreneur the team to do the thing that they say they're going to do that fits within the problem set that's there. So there's a lot of underwriting for team. And then do we believe their assumptions on the business model? Are they set up for success? Where are we going to see gaps that we can work with them through their fundraising process to identify? And so it's a long series of conversations. And then, of course, we're looking at the financial models. And in the early stage, a lot of that is like finger in the air, like directly, does this make sense? You take a heavy discount to a lot of the assumptions that are made and make sure that like our underwriting base case scenario still meets like holds up to financial muster. And then it's really a back and forth. And so we have a pretty institutional underwriting process. We have 3-stage investment committee process. Stage 1 is we have a deck. We've maybe had like one or two phone calls. We write up a short 3-page memo, pretty informal, present it to our internal team and pitch it and say, like, do we like this enough to bring it to our actual investment committee? If the answer is yes, we do a slightly larger investment memo and we pitch it to our formal investment committee where we have external members who also sit on it. And they raise key questions or key considerations. And then assuming that goes well and we get the green light, we really kick off full-blown due diligence at that point. I think the fastest we can really get through something from like we found the idea to we're closing on legal docs is a quarter. There have been exceptions made in very particular circumstances, but we really don't like to rush things if we don't have to. And I think it just allows us to assess like, is this a good working relationship between us and the entrepreneur? And so in the full-blown due diligence process, what the output is about a 30-page investment memo. That's really soup to nuts on the market opportunity, the team, their product, or whatever they're trying to sell or put into place, financial overview, the impact. It's really comprehensive, and we present that for final approval. And once that's approved, we go into legal review and then kind of the closing process. So it's pretty institutional and it's very comprehensive. And what's really important is that we like working with great people. And so we like humble, smart people who just want to do the work and are passionate about it. And like, do you wake up every day and this is what your life goal is? I think I recently listened to a podcast, which I thought was a little extreme, but one of the questions that the person asked was like, their favorite interview question for entrepreneurs is like, if you weren't doing this thing, like, would you die? Like, that's a little extreme. I probably would ask like a slightly pared back version of it, but you're both entrepreneurs. Like, you have to be insanely passionate about the thing that you want to do because it's your blood, sweat, and tears and it's 24/7 and it can be lonely. And so like, that's what we're trying to get at the heart of it is like, how badly do you want this and how hard will you work?
Yeah, from my perspective, it's a question of opportunity cost and life force. It's like, how could I not do this? Like that is the, that's the impulse that I have to start something.
Yeah, totally.
How about stage? Pre-revenue? Do you need revenue?
We'll do pre-revenue. We want line of sight that you have figured out how you're going to generate revenue and you've started to test that, but we're comfortable with pre-revenue.
And how about line of sight to cash flow positivity and profitability?
Great. I love revenue and profitability.
I mean, is that one of the things that is a key criteria for you? I mean, again, contrasting with venture, where that's not often a consideration for, pre-revenue companies. Is that a consideration for you?
It is a consideration if you want debt. Like we need to understand that you have money coming into the business and we can get around the traditional 5 C's of credit. I was listening to the Zach episode, like to underwrite around those traditional metrics, but we do need contracts and we need very like regular cash flow coming in, but we can get comfortable with debt coverage ratios and get creative.
We're going to do a segment on the podcast that is new for us that we're calling the reverse pitch. So this is investors pitching entrepreneurs, where we're asking you to pitch basically opportunities that you see where you haven't found companies that fit those opportunities yet. So with that, I'm curious, what gaps do you see? What are the things that you can share with us?
Yeah, I love this question. I think we've reached this point of how we've kind of we're always trying to be on the cutting edge. And so right now I actually just hired the SO Partners team to do a consulting project for us to help find this. So like if entrepreneurs hear this, find the SO team because they're searching.
To be clear, that's David Leon and Brian Dawson.
Yes. Doing their job for them. No, I'm joking. They're fantastic. So there are a couple of key areas that we are really interested in right now, and we're actively searching for entrepreneurs or fund managers who are doing these things. As I mentioned earlier, insurance and alternative crop insurance is one big area that we've been trying to figure out a solution in. So that's either coming up with an alternative insurance model for private insurance or a data solution to help with the actuarial data alignment. And then the other area is how do we continue to generate demand and offtake for regenerative organic production? And I'm talking at scale. I think really early stage CPG businesses are really important, but I think there's enough players who are funding those businesses. I'm more interested in like institutional procurement of those things. And how do you start to get the institutions to buy them? And so do you want to start a processing business, or you have a processing business, or you have a new ingredient innovation business? What are the things that start to move these sometimes pilot phases of like production into large scale and really start to move pounds of product into like the food system? And so keeping it open-ended because I don't really know what that looks like, but I'm really looking for that demand pull through in the system that I just have not really seen happen at scale. And it's not really the branded CPG either.
Right. Yeah. So I'm hearing two kind of major areas. One is risk products and one is offtake. On the risk product side, I've heard from several folks that captive insurance companies are starting to be an interesting mechanism sort of throughout the value chain for various products. I'm curious if you've looked at that. How do you see that fitting into the ecosystem?
That seems to be the most promising. We are having a couple of really interesting conversations on how we can participate in a captive model, but we really like that one. The conversations we're having are not baked enough to share them yet, but I hope that as that progresses, we will be seeing that from the rooftop if it works.
And on the offtake side, I'm assuming, since you mentioned it earlier in the episode, you're talking about, one of your main goals is diversified cropping systems. I'm assuming when you're talking offtakes, you're talking sort of non-traditional crops. And that strikes me as almost like a trading platform.
Could be.
It could take a lot of different forms too. Trading in these thinly traded commodities is pretty risky. Like it's hard to underwrite that. So how do you think about concessionary or first loss capital for a company that has the impact that you want and could actually help scale production of a commodity.
Yeah, I think that's a perfect example where you will see us show up intentionally concessionary, knowing that we probably were never going to make money off of it, or we'd make a lot less. But it got that thing off the ground, and it had the potential for systems change, and we can take that financial hit if we have line of sight of that becoming mainstream.
Going back to the top of the episode where we talked about scalable climate solutions and delivering financial returns on those, how would you gauge the success that you're having in the intersection of that Venn diagram?
Great question. I think the more people we see coming to the space is an indicator of success. I think the challenging thing about this space is that the returns are going to take a while to come to fruition. And it's going to take a while for us to see if we're successful from an impact and climate space. And so, to me, an intermediary indicator is that people are willing to join us in these investments and are seeing both the financial and impact in that. And I feel like that's a short-term indicator of success, that we're not just like the crazy ones willing to fund these things, but that other people see their value from either or both. And then, of course, longer term, I think in the food and ag space, my goal is to see policy shift around this. And we need policy shift to support some of these things. And so it's insurance shifts. Zach had started to see, we saw that shift start to happen with FSA and Zach. And so over time, how do you take the public sector and support some of the things that the private sector has proven need to shift? And I think there's a strong role for both private and public capital into these things. But the fact of the matter is, in ag, like, you cannot do this in isolation without acknowledging that there's a massive elephant in the room with the policy side of it. And we can start to get the wheels turning and show that this is a very depoliticalized way to invest and that it actually benefits everyone. And so we're filling a gap in the short term and finding financial levers and financial returns. But ultimately, like, policy has to take over, I think.
I'm curious how, with the policy shifts that are happening now and the political shifts, does that, and the, funding being removed for some of the projects, not some, many of the projects that are out there, does that change you all's commitment? Have you reassessed it all? Like, what's the impact for your work?
Yeah, we still remain deeply, deeply committed to our work. And that is we're not pulling back in our allocation. I think we have always been kind of underwriting to an administration change. I don't think we were anticipating that there was going to be a pause on committed contracts that were receiving federal funding, and that mess seems to be working itself out. I don't know, Sammy, you're much closer to this than I am. But I think we are leaning in. I think we're also acknowledging that we can't save everything. And so we have to pick and choose where we're deploying capital even more intentionally now, which is really unfortunate. But I think we have to think about the capital intensity of these things and where, like, things have viability to move forward.
I'm curious if you have any final thoughts to leave our listeners with.
Yeah, well, this is so fun. So thank you for having me. I would just encourage both entrepreneurs and investors, if you're curious about the space, like, just do it. There's so much that can be done, and there's so much white space, and there's so much opportunity that I think it's a really wonderful space to be operating a business in or a portfolio in. And I found it to be a hyper collaborative ecosystem and very supportive. And so we need more entrepreneurs, we need more investors in the space. And so my simple message is just do it. Like, come join us.
You're clearly doing vital work in the space. And as founders, I want to thank you for that.
Thank you.
Thanks for joining us.
Thank you for all of the work in this space. It's deeply appreciated and inspiring.
Really appreciate you joining us today. Thank you.
Thank you.
Thanks for listening to this episode of The Business of Soil Health. Our goal is to explore how new financial tools may or may not support producers' stewardship of their soil. We love hearing from listeners, so don't hesitate to reach out with any suggestions or guests you'd like for us to feature. And don't forget to subscribe or leave a review on your favorite podcast platform.